This is part 2 of chapter 3, and now what we're going to do is walk through the process of preparing a classified balance sheet. Now, current asset valuation, listed based on expected conversion of cash. That's how they show up on the balance sheet. Sale or composition, either in 1 year or the operating cycle, whichever is longer. Valuation based on cash and cash equivalents is fair value. Short-term investments are fair value and they're amortized if there's any discount or premium. Receivables, net realizable value. Inventory, lower of cost or market. Prepaid expenses at cost. Now we're going to walk through an example. Now let's prepare a classified balance sheet using this adjusted trial balance. We start with current assets based on liquidity. Now whenever I'm doing a problem like this, I like to check things off as I use them, because whenever you're going from a trial balance to the financial statements, you only use the information once. Now in this example, which is not normally what you would see on adjusted trial balance, what we have done is rolled up net income minus dividends into retained earnings. So therefore we can use that number on the balance sheet. So now what I'm going to do is check off all of our current assets. We start with cash. We do accounts receivable, less allowance for doubtfuls. We would include inventory. We have marketable securities, but only half of them, because they say half is going to be next year, the other half would be long term. And the last would be our prepaid expenses. So now we can start our classified balance sheet. So we'd start assets, current assets. We'd show cash, our marketable securities, our accounts receivable net, our inventory, and our prepaid expense, and now we have our total current assets. Now we're going to do our non-current or long-term. So conversion to cash for greater than 1 year or the operating cycle, and this would include in securities, tangible fixed assets, special funds, and non-consolidated subsidiaries or affiliated companies. So now what we're going to do is we're going to check off all of the items that would be part of investments. And remember, we still have half the marketable securities. So we would take that half of the marketable securities, and we would take the $50,000 of the $175,000 that is being held for investment. Non-current assets are investments. We'd list first. We'd have the balance for our marketable securities and $50,000 of the $175,000 for the land. And that would be our total investments. Now we move to the section called property, plant, and equipment. So we're going to select the building, the equipment, the accumulated depreciation, and the other $125,000 of the land. So we go back here and we now have PP&E, and we're going to list the land, the equipment, the building, less accumulated depreciation, and that gives us our total PP&E. Now we're going to look at intangible assets. So intangible assets are assets that you can't touch or see. So that would include goodwill and patents. Now we can add those to our equation. Intangible assets. We would show our goodwill, our patent, we'd show a total, and now we have our total assets, and this is the number that has to tie to our liabilities and equity. Now, current liabilities are broken down in just two categories. We have current or long-term. So, we start with this. We have a accounts payable. We have a portion of a notes receivable of $50,000. And we have our deferred revenue and our interest payable, unless they tell us otherwise. So now we can go here and we can list our current liabilities. And that gives us our total current liabilities, including that current portion of that long-term note. Now we can do our non-current. So what we want to remember is we've got $75,000 left on that long-term notes payable. We have the premium on bond, which has to follow the bonds payable. And now we have what we need to do the long-term or non-current section. So we go bonds payable plus the premium and the notes payable portion that's not current. And now we have our total liabilities. Our next section is owner's equity. It would include capital stock, additional paid-in capital, retained earnings, accumulated other comprehensive income, treasury stock. And that's always a minus. And if there's any non-controlling interest, you would get this if you're a company and you owe less than 100% of another company's stock, but more than 50%. So now we would include the common stock, the additional paid-in capital, and the retained earnings. So now we can do our last portion. Stockholders' equity, additional paid-in capital, retained earnings, total equity. We add them together, and if you notice, the two numbers equal. And that ends part 2 of how to prepare a classified balance sheet. Again, if you have any questions, you can always email me. Thank you so much.